one of the things that I love about Bitcoin in particular is my economics background matters. And so here are all of these developers and young people very interested in the space. And like, I want to learn from them and they want to learn from me. So it's been fun. So much, I mean, it's brought in probably all of my expertise from an investing point of view and from an economic point of view. And it's wonderful, that this can bridge that gap, the economics and the technology. In the early days, so we started our research when we were at AllianceBernstein first. That was 2011. Founded ARC 2014, did the research. And in fact, when we first broke out the 5 major innovation platforms, we did not have AI and blockchain there. We had instead we had that in mind, but we had next generation internet. And as we started doing our Bitcoin research, I brought in Art Laffer, who is a very well-known economist, known for fiscal policy theory as well as monetary policy theory. And he agreed to collaborate. And when he said, "This is what I've been looking for ever since we went off the gold exchange standard in 1971, a rules-based global monetary system." And I said, "Oh, wow, how big could this be?" And it was only a $6 billion, we called it network value at the time, market cap. He said, "Well, how big is the U.S. monetary base?" And I said, "Well, it's $4.5 trillion. And now, of course, it's 8 trillion, 7.5, 8 trillion. He said, "Well, there you go." And so I bought personally, and
that's a big number, Art.
And in fact, Chris Bernisky was our analyst at the time, and there was no vehicle to put it in our funds. GBTC was just coming of age, and we were doing our due diligence, and so I bought $100,000 worth just personally, and Chris became like, here I am, the portfolio manager, and it was his research that moved me to do this. And like, it was so early. And so he doubled down on his research.
It's bad if your boss loses money because of your research, right?
But then of course, the rest is history. I guess we're at, is it 300 billion-ish?
Something like that, yeah.
Now. And many people know that we think that's 300 billion in market cap or network value at $24,000. And we have in big ideas, again, our forecast for 2027, I think, is around 650,000, and beyond that, 1.5 million.
Traders dumped risky assets following the crisis and failure of Silicon Valley Bank. The S&P 500 index plunged 4.55%, while Bitcoin is down about 9% this week. Hello and welcome to Crypto Street. In today's video, Cathie Wood, CEO of ARK Investment Management, updates us about the recession fears and the current market cap of the crypto industry, and reaffirms her firm belief in disruptive innovation.
The two numbers we have our base case is roughly 650,000 for 2027. Now that has come down. We were using 1 million plus 4 or 5 years out, but because we've had the debacles associated with centralized, opaque institutions, as opposed to decentralized and transparent, institutions are going to hold back a little bit. But we still think that the million plus is right. In our bull case. And you can see how we build our case and look at the assumptions, how much institutional involvement and so forth, very conservative assumptions. And our conviction actually has grown through this past year, because FTX, Celsius, 3AC, Voyager, all of these were centralized, opaque institutions. They went bust. And even the centralized regulated institutions, now we're looking at Genesis, probably bankruptcy, yes, Silvergate, these are regulated. And but again, they're much more centralized and open. Right. Well, Bitcoin came out of 0809, right? And look at all the regulated companies that went under then, and all of the counterparty risk that nobody understood, and all of the paperwork that had not been done. So, I do think about what you're saying. I don't think we worry about the innovation that is leaving the U.S. and moving to other countries who are much more friendly. The U.K., I think, and Europe generally, from a regulatory point of view, has much more of a solution, more clarity than the U.S. But I think the American DNA is such. And we see it in how regulators are going this far. And the most interesting one to me, now consider the source. We own it. I want to be very clear.
Everything that we've spoken about today, you should assume one of the two of us owned it.
Right. So Coinbase. Now, I'm listening to the regulators, and they're saying, well, if it looks like a security and it walks like a security and it quacks like a security, then it's a security. And we will enforce the securities laws. That's what the SEC does. And I'm thinking, well, Coinbase had to go through the SEC. They had to issue an S1. Highly regulated. They had a lot of tokens that now the SEC is questioning as securities. Well, has the definition of its security changed since Coinbase went public in 2001? They went public around the time that Gary Gensler came in. So maybe that's where the disconnect is. Gary Gensler is much more of an enforcer. I don't know. But the definition of a security should not have changed. And if they didn't think these should have been on Coinbase's platform, then they shouldn't have let them go through.
The collapse of SVB led to a crisis in the crypto space, with USD coin losing its peg to the US dollar on reports that $3.3 billion of Circle's $40 billion of USDC reserves were held with SVB. After trading near 87 cents on March 11th, USDC has climbed up above 96 cents at the time of publication. SVB's failure has increased uncertainty in the short term, with investors closely watching for any signs of the contagion spreading to other regional banks across the United States. During times of uncertainty, it is best to stay on the sidelines. However, if there is no domino effect following SVB's debacle, select cryptocurrencies may start their recovery. The cryptocurrencies selected in the article are all trading above the 200-day simple moving average, a key level watched by long-term investors to determine whether the asset is in a bull or bear phase.
I think what it is a process of iterating to the right answer, and it's very messy. So if you look at how derivatives evolved in the markets, it was very messy. They had to put in place not a completely new regulatory structure, but they had to they had to bring the CFTC into the discussion, and we got a whole bunch of new guidelines and rules, right? So I think that's where we're going with this new asset class, which we really do. We believe it's a new asset class. I know that, but I know there are securities associated with the new asset class. So let's just be clear. Bitcoin, you've told us, is not a security. Great. Coinbase clearly is a security, and it has on top of it assets that could be a new asset class. So I think we're iterating. It's been very messy. Even this a concept of staking, I don't know if you saw Gary Gensler's video where he said, no, I'm not talking about stake, S-T-E-A-K. He's trying to, make this very, he's trying to be approachable, and I'm talking about S-T-A-K-E. And then you look at okay, the one that Paxos basically said it would stop staking.
There's a couple of, I think Kraken said it, and Paxos as well. Yeah.
Kraken. Well, Coinbase has a staking service, but it is a utility, not a security. So again, we're iterating, and it is interesting to watch the SEC try to figure this out. You're right, that is a service. It's a technology here. It's a security here. And it's like, it's complicated, right?
So what are your thoughts about Cathie Wood's prediction? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.